Today we are going to explore the financial statements of a company. Ever wondered how investors make their investment decisions? It all starts with understanding financial statements. Think of financial statements as the report card of a company. Just like how report cards help you assess a student's performance, financial statements provide a snapshot of a company's financial health. They offer a wealth of information, from the company's revenue and expenses to its assets and liabilities. But that's not all. They also reveal key insights into the company's cash flows and equity, painting a comprehensive picture of its financial performance. This makes them essential tools for investors, as they can use these statements to evaluate the potential risks and returns of their investments. They can examine the company's profitability, gauge its financial stability, and even forecast its future performance. Now, you might be curious about what these financial statements are. Let's dive in. First up, we have the balance sheet. It's like a photograph of a company's financial position at a particular moment. Picture it as a financial snapshot, capturing the state of affairs at a specific point in time. Now the balance sheet is divided into three main parts. Picture a scale, perfectly balanced. On one side we have assets, the things a company owns. This could range from cash in the bank, to properties, to patents. If it holds value, it's an asset. On the other side of our scale we have liabilities, what the company owes. This could be anything from short-term debts like accounts payable, to long-term obligations like bonds payable. But a scale needs balance, right? Here comes the crucial part. The balance is provided by shareholders' equity, which is the value of the business to its stockholders. It's what's left over when you subtract liabilities from assets. So, if our scale is balanced, then the total assets will always equal the total liabilities plus shareholders' equity. It's a fundamental principle that keeps the balance sheet, well, balanced. It's important to remember that the balance sheet is just a snapshot. It doesn't tell you the whole story of a company's financial health, but it's a great starting point. So the balance sheet gives you a snapshot. But what if you want to see the company's financial activities over a period of time? That's where our next statement comes in. Meet the income statement. Think of it as a video that plays out the company's operations over a certain period. It's the storyteller of the financial world, spinning tales of revenue, costs, and expenses. Like any good story, it has a beginning, middle, and end, and every element is crucial to the plot. The beginning is the total revenue, the money that the company has generated from its business activities. This is the top line of the income statement, and it sets the stage for everything that follows. Then, we move to the middle part of the story, costs and expenses. Costs can include everything from the price of raw materials to the wages paid to employees, while expenses are the costs that are not directly tied to production, like rent or advertising. Subtracting these from the total revenue gives us the operating income. The end of the story is the net income, also known as the bottom line. It's what's left after all expenses, including taxes and interest, have been deducted from the revenue. This is the number that tells us how profitable the company was over the period in question. The income statement, then, reveals the steps that management has taken to arrive at the net income for the period. It's a snapshot of the company's financial performance, but it's not the whole picture. While the income statement tells you what happened over a time period, our next statement shows you where the company's cash is going. Say hello to the cash flow statement. It's like the company's checkbook register. This statement is a record of the monetary comings and goings, showing us where the company's cash is coming from and where it's going. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Let's break them down. Operating activities represent the heart of the business. This section shows how much cash the company is generating from its core operations, like selling products or providing services. It's like the company's pulse, indicating its day-to-day vitality. Next, we have investing activities. This reveals the cash spent on investments like property or equipment, and the cash earned from selling these investments. Think of it as the company's growth strategy, showing how it's reinvesting its profits for future expansion. Lastly, financing activities show the cash transactions with lenders and shareholders. This includes dividends paid out, shares issued, and loans taken or repaid. It's like the company's lifeblood, showing how it funds its operations and growth. The cash flow statement, in essence, tells us whether a company can generate positive cash flow to maintain and grow its operations, pay back its debts, and return money to its shareholders. So, we've covered the three main financial statements. But how do investors use them? Investors have a knack for using these financial statements to assess the viability of investing in a company. These documents are like the company's report card, providing a snapshot of its financial health. Investors begin by analyzing the balance sheet. They look at the assets, liabilities, and shareholders' equity to evaluate the company's net worth. A company with a higher proportion of assets to liabilities is seen as financially stable, making it an attractive investment. Next, they turn to the income statement. This document tells them how profitable the company is. They scrutinize revenues, costs, and net income. A company with increasing revenues and net income over time is viewed as a growing entity, promising good returns on investment. Lastly, they peruse the cash flow statement. This shows them how much cash the company generates and spends. A company with positive cash flow is considered healthy as it can pay off its debts, reinvest in its business, pay dividends to shareholders, and endure tough times. But it doesn't stop there. Investors don't just look at these statements in isolation. They compare them over time and with competitors. They use ratios and other financial analysis tools to evaluate the financial performance and make predictions about future performance. This analysis forms the basis of their investment decisions. It helps them identify potential risks and opportunities, decide when to buy or sell shares, and determine a fair price for the stock. So next time you're wondering how investors make their decisions, remember it's all in the financial statements. If you find this video informative, hit the like button and subscribe to the channel for more financial content.